Do il benvenuto sul nostro palco a Marc Chapman. Vieni Marc, grazie, un applauso, gestore di Principia Fund. Ok Marc, io tanto mi metto questa. This is for you. Ok? Allora parlerò piano perché Marc non parla benissimo l'inglese, quindi cercherò di venirgli un po' incontro. 25 minutes right now. Talking with management teams of European companies, what do you expect in terms of business opportunities in 2014?
Okay, our strategy essentially is to meet lots of European companies. We meet more than 400 corporates throughout Europe over a 12-month period, and so we get a good overall impression of which sectors are performing well, where there's opportunities, and where new growth avenues are arriving. Essentially, companies focused on European growth are seeing an improvement in conditions. So advertising markets in Southern Europe are becoming more stable. The automotive market, which has been declining since the crisis, has also stabilized in Europe. And so companies such as construction or automotive-focused European companies are benefiting from the stable macro trend. On the other hand, internationally orientated companies are seeing a divergence in performance. In the US, the market has recovered well, economic growth has been good, and conditions have been generally favorable. In the emerging markets, things have been much more difficult. So for instance, in China, in luxury goods, there's been a sudden demand down move, essentially linked to some government policies. And that's caught some of the luxury goods companies off guard, and they've had to adjust their strategy to basically cope with that environment. So overall, it's a divergent outlook. But in general, I would say companies are relatively more confident than they were 12 months ago.
Okay. Are they generally more bullish or more bearish than in 2013 on their own business?
I think it depends on the sector that is being addressed. Companies which are focused on emerging markets are slightly more careful. After a period of strong economic expansion, they've essentially seen a stabilization and sometimes a decline in demand. European-facing companies are much more confident. They're seeing overall stabilization in lots of the product markets in Europe. And in general, demand has stabilized. The crisis period has passed, and is still in people's memories, but not so vivid, and that's leading to generally more confidence in terms of investment behavior, spend on expansion, capital expenditure, and potentially acquisitions as well.
And do you still see a huge gap between the opportunities in core Europe and peripheral Europe?
In terms of the equity valuations across Europe, I would say that the southern European markets have followed the bond markets. So the reduction in bond yields in southern Europe compared to northern Europe has resulted in also a strong revaluation of the European equities which are located in Spain and Italy. And at current levels, we think there's perhaps more risk in some of these companies' forecasts. For instance, in the advertising market in Spain, the free-to-air TV channels are seeing a stabilization in terms of ad spend. So demand is no longer declining, and it may start growing next year. But the problem is companies like Mediaset España, partially owned by Mediaset in Italy, have re-rated aggressively over the past 18 months and are discounting a quite optimistic scenario. And I think that's probably unlikely. I think a return to 2007 levels of advertising spend is not likely in the midterm. I think the growth will be positive, but subdued. So in some cases, we think there's overvaluation in parts of southern Europe, and that's presenting some interesting short ideas. In northern Europe, the valuations are still good. The valuation compared to bonds is attractive. The dividend yield is still good, and the valuations are not stretched, despite the re-rating they've had over the past 2 years. So a divergence by company as well. We see less of a broad brush appreciation of the markets and more of a divergence from now. We think the risks are essentially balanced on the up and down side, and so a more selective approach in 2014 should work well.
Marc, do you expect European companies to invest cash on their own balance sheet in 2014?
Essentially, since the crisis happened, the management teams of a lot of European companies froze in 2008 and 2009 because they were shocked by how fast the demand declined. And since then, they've been quite cautious about leveraging their balance sheets. They've been careful about bank lending and also careful about issuing bonds in case liquidity suddenly dried up. Now, since demand has stabilized and in some cases grown over the past couple of years, they've now become slightly more confident about reinvesting their cash, but not to the extent it was in 2006 and 2007. I think the management teams were burnt too much by the sudden nature of the demand decline. That said, interest rates are low and there's potentially accretive acquisitions they can do. So gradually, I would say they're starting to invest cautiously a bit more. Lots of the companies we meet in Europe have spent the last 5 years deleveraging. So they've now got net cash positions, not dependent on banks or the bond market. And so they've got some room to maneuver and spend some money on targets if they see fit.
Okay. And do you think that the recent trend of M&A and recovery of corporate finance is sustainable in Europe next year?
I think it relies on confidence in the global economy. I think a stabilization of Chinese growth and a return to the trend growth, as well as a stabilization in Europe and maybe a stagnant or very marginal growth outlook, will mean that product markets see stable demand, in which case confidence will keep on returning. And a lot of these corporates will see opportunities to reinvest in companies that are smaller than them, which are perhaps struggling or in some niche market, and where they can consolidate the entire marketplace. So lots of marketplaces have basically seen a shakeout, a consolidation over the past 5 years. Tough conditions have favoured larger companies who basically had a more entrenched position in their market. Some of the smaller companies have struggled, essentially because small companies have been seen as more risky from suppliers and customers, and they haven't had access to the financing that large companies have. So this means there's potential consolidation opportunities among some of these smaller companies across many markets.
Okay. And Marc, are you finding more long or short ideas in the current environment?
Our strategy, which is bottom-up, stock-specific, is generally geared to finding more long ideas. Usually stock pickers are more interested in finding longs. They know the company's better, the management's well, they learn about the company and understand what drives it. And so in general, you'd expect to find more longs than shorts. Recently, I would say we've been finding an even number of longs and shorts, and that's because of the trends I mentioned. I think there's a divergence in performance among different companies, and also the re-rating that we've seen in Europe, especially in European cyclicals, has presented in some cases some short-term opportunities. So for instance, Mediaset España, which I mentioned, which is a good quality media company, well positioned as an oligopoly in its marketplace, but we think that expectations of demand recovery have ran way too far ahead of the fundamentals. And so the valuation now is discounting quite an optimistic outlook for Spanish TV advertising, which we think is reasonably unlikely in the next 2 years. So we've been short of that. But also we can find still interest in long names where operating performance is still improving. Return on capital employed is growing through time, and the free cash flow generation is still attractive. So at the moment, we expect to see more divergence in terms of operating performance, and the rise in valuations presents a better shorting environment. Europe hasn't been a good environment for shorting in the past 2 years because valuations have been so subdued and expectations so low that the risk-reward has been poor. Now the risk-reward on the shorts is more reasonable, we would say. So we think that a balanced number of longs and shorts going forward is more likely.
Can you describe 2 long ideas?
Yes, the first one is Faurecia, which is a value name. It's an automotive supplier listed in France. Essentially, it started out its life as part of Peugeot. It supplies bumpers and seats which go into the which supplied the OEMs. Essentially, it's grown internationally over the past few years, and it's got a good presence in Latin America and the US. And it's linked to overall automotive volumes, but the key stock-specific point about the company is that they've grown well in America, but the profitability has been negligible, and that's because they haven't had the correct supply chain set up. They've had too high a defect rate, and they've been too distant from the customers. They have specific measures in place now which will drive returns in the US from currently 0 EBIT margin to 5% through time. That overall will pull the whole group margin up from 3.8 to 5% and generate a large improvement in return on capital. This isn't factored into analysts' models, and people are not confident about delivery of this strategy as of yet. So from meeting with the company on several occasions, we're quite convinced that the measures they'll do in the US will drive the returns. Obviously, the company will also be helped if European automotive volumes continue to improve, but that's not the main point of the case. The point is more bottom-up and stock-specific. And we think that the current valuation is very low, given the coming earnings growth. We think in 2 years' time, they can deliver an EPS, earnings per share, of about €5. And we think the stock should trade on about 7 to 8 times earnings. So it gives a target price of between 35 and 40 euros. And the share price is about 23 today. So about 50% upside over 2 years, driven by stock-specific considerations. The second one is AMS, which is a technology company listed in Switzerland. This makes analog semiconductors, which go into smartphones. It's the leader in ambient light sensors and also MEMS microphones. A very innovative company with a good R&D department focused on bringing new devices to the market. 2013 has been difficult because their most important chip, which is NFC, near field communication chip, hasn't as of yet been integrated into the Apple devices. This will happen from 2014 onwards. They're going to be the leader in the NFC technology, which will be a major new technology and which will be very accretive to their revenue growth. So after a stable 2013 and a derating of the share price, we think organic growth will re-accelerate in 2014 to perhaps 20%. And then in 2015, maybe slightly less. This year they've been continuing to invest in R&D and operating expenses. Going forward, cost growth will be slower than revenue growth, so the operating profitability and the earnings growth will be very strong going forward. And the PE rating is low, it's on 12 times earnings. So those are 2 examples of companies we focus on. Different industries in different sizes. The key characteristics are the same. There's an intrinsic stock-specific case internal to the company which will drive return on capital through time.
Can you decide a short idea?
Yeah, another short idea would be Salzgitter in Germany, which is a manufacturer of tubes and steel for the European universe. Essentially, demand has declined by 30% from 2007, and this is driven essentially by a collapse in the housing market, particularly in southern Europe. So the Spanish housing market bubble, which burst in 2007, essentially led the steel market to have overcapacity from then on. Now, demand has recently troughed because European growth is becoming more stable. But the point is that we think that the expectations on price recovery are too optimistic. The company is in losses at the moment, and it has an aggressive restructuring ongoing to reduce costs. But we think that won't be enough to drive returns to their target level. And in general, investors have become a little bit too optimistic about the hope for demand recovery in Europe. In certain parts of demand, there won't be a strong recovery. For instance, Spanish construction won't recover, essentially. There's a huge overbuild, and there's still an overcapacity. German industrial production is growing, and other parts of Europe are showing some signs of strength, but demand won't return to 2007 levels anytime soon. And because of that, we think the returns at Salzgitter are constrained. Now, consolidation could potentially help the industry, but we think that's not going to be allowed by the Competition Commission. So we think that the overcapacity, which generally comes partially from Spain and also from other parts of Europe, will remain in the market. The steel mills in Spain with very low utilization, but which are supported by the banks and which can't be closed down because the write-off would be too harsh on the balance sheet. So that capacity will remain in place and returns will remain constrained. The same case relies on Mediaset España as well, another European cyclical, where we think the forecast returns are too optimistic given the demand conditions at the moment.
Okay. Looking to your track record, your correlation with market was very low since inception of the UCITS funds. Can you explain us how you have been able to generate solid returns with such a low correlation and volatility?
Essentially, the strategy relies on two main pillars. The first one is thorough fundamental research at a bottom-up level. So looking for companies where there's a strong stock-specific case for investing, rather than being in a particular sector. For instance, Faurecia has a US turnaround, and AMS has a new chip which is going to drive growth. Based on that, we're able to identify businesses which can outperform their sector and their market. The second plank of the strategy is to manage position sizes, so and basically trade volatility. If stocks run towards their target, we reduce them. If they move away from their target, we add to them, assuming the fundamental case is correct. And generally, we try to manage downside by managing the overall positions in the fund. That, together with our overall impression of sentiment, gives us the correct exposure to the market. So we have a vague top-down framework which tracks sentiment, and if we think the market's too optimistic, we'll reduce exposure and become more cautious. If we think it's too pessimistic, we'll try and add to risk. And in general, through the life of the UCITS fund and the previous long-short fund, that's protected the record from aggressive downside.
And the last question, how do you expect scenario for your strategy in 2014? Similar, better, or worse than average?
The strategy essentially relies on the divergence of operating performance between companies, not market direction or sentiment towards Europe or any macro trend. It's that key point of divergence which we focus on, identifying companies which are going to deliver in terms of operating performance above expectations and where valuations are attractive, and shorting those where we think valuations are already full and where earnings expectations are too confident. That divergence drives performance. Now, in a trend bullish market like 2013, it's more difficult to drive that divergence because everything's rising quite quickly. In a more stable market, where risk-reward is more balanced, which is perhaps what we expect going forward, we think that divergence can assert itself a bit more. The cost of protecting the portfolio using options also declines when the market stops rising so much. So we think a less aggressively bullish environment is more beneficial for the stock picking strategy. So slightly better, cautiously I'd say slightly better in 2014.
Okay, thank you very much, Mark.
Okay.
Thank you, okay, thank you. Ringraziamo